Excluding additional non-standard measures to boost liquidity, suppress key long-term interest rates, and incentivize loan creation, the Fed cannot pull back from quantitative easing without causing financial instability, both within the United States and especially with their trading partners. This is under my assumption that further action by key central banks are increasingly more limited. 1. As the Fed pulls back, risk trends and tightening liquidity conditions will severely impact growth prospects on a global scale. 2. Dangers from the financial crisis remain, as central bank and government backstops did not allow for a full correction in 2008 and 2009. In essence, central bank measures have attempted to boost credit and leverage in an already overextended environment. 3. Central banks in the West are hard-pressed to raise rates, and the longer that zero interest rate policy prevails, the more pressure we will see on wage growth, confidence, and inflation. 4. The Fed and other major central banks are beginning to face credibility issues with regards to their forecasts and forward guidance, and this further limits options moving forward. Now, since 2008, as we know, the Fed, ECB, BOE, BOJ, they've adopted low rates in the face of a crisis. Simultaneously, the stimulus-led moves out of China have kept their economy humming along, and massive infrastructure projects boosted their demand for commodities. Those actions propped up nations whose export industry benefited from that boom in commodities, and capital flew to those emerging markets as capital in the West sought higher yield in the face of low rates. In essence, Chinese stimulus combined with the Fed's non-standard measures have helped the global economy avoid an economic depression. Still, those measures have disguised key stresses in financial markets that a move by the Fed to end its asset purchase program would expose and could expose. We must recognize that actions by the Fed to suppress rates, in addition to stimulus measures from the PBOC and Chinese government, have led to unhealthy, speculative, and bubble-like investment behavior around the globe. We cannot sit back and ignore what a reduction in the Fed's accommodative measures will have on the global economy. So as we have already seen just after a $20 billion taper since December, the Fed's actions have led to stresses in money markets from Europe to China and massive outflows from higher yielding but more risky emerging markets. Those stresses in money markets can be seen not just in terms of actual rates, but also their impact through key data out of the US, Europe, and China. Of course, growth in the West would be one way to calm markets moving forward, but can we expect sustainable growth at this stage? A bullish argument says that there is lots of cash sitting on the sidelines that can be invested moving forward. That is true, but will that money be loaned out in this environment? Banks are being hit with higher compliance costs, and regulations are forcing them to adopt higher reserve requirements and make loans on a more stringent basis. So Drahi has floated the idea of negative deposit rates, but will punishing banks further for holding cash really instill confidence in the marketplace? Certainly not. Janet Yellen has said in a recent Fed testimony in front of Congress, she said that negative deposit rates are impossible to implement by the Fed. But the Fed honors tens of billions of dollars in reverse repos every day, and the rate earned by those banks by parking their money at the Fed is negative in real terms. The Fed's actions have also hurt growth prospects moving forward on a structural front. Let me explain. Although standard economic theory tells us to keep low rates in this environment, many academic central bankers are unwilling to recognize the adverse impacts of ZIRP on a longer-term basis and accept that low CPI is a result of little to no wage growth. The Fed has attempted to tackle low CPI and boost the economy with quantitative easing, but no amount of central bank easing will fix structural issues in debt markets or structural issues within the economy. Those fixes come from reform and sound government policy. By suppressing rates, the Fed is in essence subsidizing inaction on governmental reform and making the future more precarious. Politicians can risk a U.S. default and continuously avoid bipartisan efforts to help the U.S. economy and boost wage growth because they face no retribution from the bond market for their inaction due to the Fed's QE program suppressing rates. The Fed's non-standard measures have not only led to unsustainable confidence and complacency among politicians, but more so in the global marketplace among investors who have positioned themselves as if the punch bowl will never empty. In accordance with these reasons and more, I believe that phasing out of quantitative easing will lead to a more uncertain economic environment, especially in the context of diminishing growth prospects out of China as the government seeks to shift growth led by exports to an economy founded on domestic consumption. I look forward to discussing these issues in more depth with my fellow emerging market leaders in Hong Kong this March.